On today's episode, we are going to take a look at a few growth stocks that you should add to your watch list right now. The first one we're taking a look at is one that is changing the way we purchase vehicles. It is just in a few cities right now, and it is expanding and seeing huge growth in the upcoming years. The next company is one that's changing the way we build things, and they actually have a strong backlog, and working with big companies like Taco Bell, like Puma, they also have some contracts with the United States government. Like always, my name's Jose Najarro. I am a self-taught investor who's been doing this for over 6 years now. If you want to keep learning about new stocks, make sure to hit the subscribe button and don't forget to hit the thumbs up. It helps so much with the YouTube algorithm. Finally, make sure to get your free stock. You should see the link down below for Webull. If you deposit $100, we both get a free stock. For each of these companies, we're going to take a look at fundamentals. We're going to take a look at future growth. We're going to take a look at technicals. So hope you guys enjoyed today's episode, and let's get started. Let's start off with Shift Technology Inc. So this is ticker SFT. Right now it has a market cap of $682 million. So SFT, we can see, first thing I'm looking at, charts. Again, I'm not much of a technical guy, but I use it to some extent. First thing I'm seeing, a lot of volume being bought out, or a lot of volume is transaction at this stock price, right? So a lot of people are buying and selling. We can see there's some nice floor here. So that's a good thing. Another thing I'm looking at, it is not overextended. Right now, it's not overextended. The only thing is, I know a few people might say it is in a bit of a downtrend, right? So a lot of people would wait for it to break out of there. Like I said, I'm not much of a technical guy, so I don't really care about stuff like that, especially if the company looks pretty cool. So yeah, 690 million market cap. And for those that don't know, Shift is a way to completely reimagine the way to buy or sell used cars. I honestly hate the dealership, and most of the cars I buy are always used vehicles. I don't remember when's the last time I bought a new vehicle. But I think my last 3-4 cars have been used vehicles. So it's definitely a great thing to go about it. So I can see the potential market in there. Let's take a look at future growth. Let's see if there's anything we can see about it here in Simply Wall Street. First thing I want to take a look at, future growth. So the company is expected to grow 74% on average for the next 3 to 5 years. This is a hyper growth stock. We can see the company, unfortunately, is not profitable, but it does have positive cash flow from operations. Unfortunately, it does not have positive cash flow from operations. So this is going to tell me to do one thing. When we take a look at the financial health, it has to be a very, very strong balance sheet. Cash flow from operations was increasing over time, and it was getting close to being profitable, positive in cash flow from operations. But maybe because of COVID situation, it kind of took a downturn from there. So we have to understand like what happened previously. We can see, right, the overall trend seemed to show that, hey, we were going to be positive cash flow soon. But maybe COVID might have impacted this situation. And is this company, where is it traded? I did not see that. So SFT is headquarters in San Francisco. They have a NASDAQ. They're traded under the NASDAQ as ticker SFT. So let's take a look at SFT's investors relations website. I'm pretty sure they might have some there. And then I just want to take a look at Shift Technology, their main website, try to understand the product that they have. So to browse cars with Shift, choose a location. So we can see right now they're mainly in California. They're in the West Coast for sure. You can see some Washington, some Oregon, but mainly in the California region. This tells me one thing, right? If they are growing right now, a huge reason their revenue is probably going to be expanding right now is because they're just hitting a few markets right now. They're pretty much just in California, Oregon, and Washington. Imagine when they start hitting states like New Jersey, New York, have huge populations, Texas. So they are in Florida and Dallas right now. They are in Austin. Just want to look how their website goes. So it really reminds me of what's that new website that a lot of people are using right now? Carvana. It kind of reminds me of this Carvana vibe. The website looks pretty cool. Yeah, so they are a Carvana competitor. And one thing I wanted to see was how was their website different, right? I do believe Carvana's website might be a little bit nicer right now, but it's definitely not a bad one. All right, so now that we understand, let's take a look at their investors relationship. So if you guys, this is your first time here, my favorite thing to look at is definitely the company's investors relationships website. You can learn so much about a company there. So corporate presentation, this is probably it. So Shift, this presentation is their presentation from October 2020. Shift provides 3-step full auto sales. So they can buy your car, recondition it, they fix up the car if anything, and then they sell it in their channel platform. Like we saw right now, they are just focused in California, but they are expanding into other markets. And I do believe that's the huge growth of this company. They're only hitting about 5 cities in California right now, only hitting a few cities in Texas, and I forgot where was other stuff, Washington and Oregon. So there is huge potential. So here they're kind of comparing themselves to Carvana. If proportion of car listing by age of car. Cars less than 3 years old, most of them are, a huge percentage are in Vroom. So it's showing you that Vroom has a lot of newer vehicles compared to CarMax, compared to Carvana. So Shift's cars are actually not that new. They're in the 1 to 3 years. Shift has older vehicles, about 4 to plus years. Maybe some people might like that. In all honesty, that's something that I'm not too fan of. It's pretty cool to see this. And here, right, this is the cool thing about looking at investors' presentation. You can kind of look at all their competitors. Here, I can see that Vroom actually has most of the newer used vehicles in the market, followed by CarMax, followed by Carvana. The slowest one is Shift. That to me is a big deal. Like I mentioned, I personally, from my personal way, when I buy a used cars, and like I said, my past 3 used cars have been old, I usually purchase them no more than 3 to 4 years. So Shift is kind of not going to usually be hitting my kind of marketplace. Vroom, CarMax, and Carvana would. If I was in the mood to buy older vehicles, then maybe Shift would be that market. Proportion of listing price, of course, because they are a bit older, they're most likely going to have the higher lower end cost. So they have $10,000 or less, and then Shift has about 10 to 20,000. So they seem to have more reasonable thing. But yeah, like Young Investor says, they are a baby in the group, brand new. So maybe right now they just have a bit of customers, but once they start expanding into new states, this overall segment can change. So is anybody investing in like Vroom or Carvana? I know Carvana has done amazing recently, but Shift Technology, pretty interesting market. Not one, I'm not too much in the used vehicle market in the whole transformation of the dealerships. I know a lot of people are into it. It looks pretty cool, right? It's a market I can definitely see growing. Like I mentioned, I personally hate going to dealerships. And my most recent vehicle that I purchased 3 months ago, it was actually, I was almost gonna go to Carvana, except it's still a brand new thing, so that's the only thing that stopped me from doing it. But I do think my next vehicle from here is either gonna be bought in Carvana or one of these platforms. Whoever's doing it, great. The most recent revenue was here, the third quarter of 2020. They had over 4,000 units sold. Their adjusted gross profit grew 156% compared to the same time last year. That's pretty good. Their total revenue grew 31% year over year, and it grew 85% from a quarter ago. So we're seeing strong revenue growth. The overall units sold were up 34%. Most of them were being sold through the total e-commerce website. Gross profits grew to 3.7 million. So they are gross profitable, which is good. That's 6.2% of their revenue, of their total revenue. Usually dealerships, even when they are like this in the e-commerce platform, I want to say, they still have very low margins. So 6.2 margins, I want to see how much more they can grow compared to, they were negative gross profit per unit a year ago. So that's actually pretty good. Adjusted earnings before interest, all that, it was a loss of $19 million. So they are losing right now. They are losing money right now. Cash and cash equivalents. Oh, here they talk about it. Cash and cash equivalents were 18 million as of September 30th of 2020. The merger, which ended after quarter three, delivered an extra $302 million there. So the company right now paid down a 6.1 million balance on its PPP loan and the 25 million balance on its delayed draw term loan. So this company, because of the SPAC merger, it got a nice amount of money. With that money, it paid down a nice amount of debt. It has about, let's say, $275 million outside of that. So this is ticker SFT. Right now, it has a market cap of $682 million. So that I want to take a look at cash flow from operations real quick, just to see how cash flow is burning. So cash flow from operations for this year was a burn of about $45 million. Let's say for the full year of 2020, because that's for 9 months, it's about $60 million, $15 million each year, each quarter. So that's about $60 million a year. They have about $260 million in cash right now after that merger. So in theory, they're going to be able to survive for the next 2 to 3 years with the amount of cash without taking out new debt, without doing a new second offering of some sort. So right now, their balance sheet is actually pretty strong. Young Investor is saying that they spent so much money on marketing, and that's expected, right? A company that's just starting off right now, most of their money should be spent in advertisement. So here we can see where's their advertising cost. So they're spending a lot of money right now on marketing. It's in the selling department, I guess, is where they have it under. So that's where most of their money is being burnt off. And that's okay, right? They need to increase the overall exposure of their brand. So overall, SFT looks pretty cool, right? We see it's not overextended. It has a great market cap. It's growing at strong levels. We see the company's growing. Analysts expect this company to grow dramatically. It is brand new. It's only in about a few states. The overall expansion to other states can definitely grow this company. The things I'm not liking right now, in my opinion, is it's not cash flow from operations, right? It's my first thing I'm not liking, but we saw with the balance sheet, it has plenty of cash to survive for the next 2 to 3 years without taking a new debt. The second thing I don't like is, to me, the automobile industry, even though it's a market I can see, right? This is a market that needs to be changed out. It's going to be a market with very low margins, in my opinion. So that's something else to note. And right now we have strong competitors with Carvana, with Vroom. So either way, it has its good things and it has its negative things. For me, I'm just not in the automobile industry right now. Sgbx seems pretty interesting as an engineer, even though probably here most of these are civil engineers, not as cool electrical engineers. So Sgbx is another NASDAQ traded, so it's traded here in the United States, headquarters in the United States. But it looked pretty cool, Young Investor. Thanks for bringing that one up to us. So Sgbx. Now let's go to the company's website. So Sgbx built the first ever Starbucks drive-thru utilizing shipping containers located in South Lake City, and is the first of several prototype stories to be built. That's actually pretty cool. So they built the Starbucks here. That's actually pretty cool. That's pretty insane that they've done that through just containers. There's a Taco Bell, like Young Investor mentioned. They also made a Puma store, and actually this is pretty smart, a Puma show store. So it's not as simple as it looks. As a matter of fact, it's really hard to turn a container into a structure that works. We know how to do it right. So they are the industry leader engaged in Sgbx with good reasons. They have proprietary best in the class container based testing and modeling. They done stuff for Starbucks, the Hamptons, Seaport, Mini Cooper. All right, so the company's looking pretty cool, right? This is a pretty cool market, in my opinion. Definitely smaller. So construction is 40% faster. I'll go on their Twitter, and they save about 10 to 20% on construction cost. Who's building with Sgbx? Like we saw, right? They have the Department of the Air Force. That's actually pretty crazy. I want to see how they are built. Why is the military using them? I'm guessing the blocks are easier to build, easier to transport, and they're able to resist harsh weather like in the desert or in the rain. So it might be better to do that stuff. And it could be pre-built already. So Department of the Air Force, United States Marines Corps, they have the Navy, they have the Army, and camouflage as well, right? They have Mini Cooper, Schneider Electric, which is a very big electric company. They have Equinox, a fitness club. I can see a lot of gyms being set up like this. The resorts, Taco Bell, Puma, Starbucks. Moro, may I ask, what do you mean? Graphics all time SG blocks is scary. That's what you mean. Okay, all right. Yeah, that's something I don't like to see, right? I have. So I'll do a quick overview. So I'm not a huge fan of companies that have some form of stock price like this. One thing we have to understand: has there been a transition in things, right? So it's I talked about it in my last video. It's a mixture of people at some point overvalue the past too much and undervalue the future too much. I feel like there has to be a perfect balance between the two. So we have to understand what happened in the past. Is there some new company? Is there some was there just some weak place in their company? And now in the future, are they now a new company? Did they get removed out of a new company? Have they split up? So stuff like that are things we have to look at. But just looking at a stock price like this, yes, is pretty scary, but at the same time, it shouldn't deter you. And here, Young Investor mentioned it. So they split from a large company. Main reason, most likely the stock price dropped a lot. Wow, so imagine this year they will have $20 million in revenue, 400% growth compared to the same time last year, $13 million in cash, and 0 in debt. All right, so look, if they have $20 million in revenue for this year, that gives them a price to sales ratio of about 3. That's actually pretty cheap if we take a look at their balance sheet, at their margins and stuff like that. So let's take a look at fundamentals. So here we have Sgbx. So Sgbx, SG blocks, right now, future growth. Company is expected to grow dramatically, 182% for the next 3 to 5 years. This is insane, right? That's a huge grower. They are not profitable right now. Cash flow from operations are also negative, but let's take a look at that financial health. Remember, they are seeing strong revenue growth right now. So what's important is if they don't have cash flow from operations, if they don't have positive earnings, they need to have a strong balance sheet. Just like Young Investor said, they have $13 million in cash and short-term investments, and they have no debt whatsoever. This is amazing. This is I enjoy seeing balance sheets like this. One thing I want to take a look at is their cash flow from operations really quick. How much of a burn rate was it? Cash flow from operations was about $4 million per year. So on average, if they're burning about $4 million per year, it means this company can survive with that $13 million for at least 3 years without taking on new debt, without doing a second offering, without making any money. So obviously a company is going to do that stuff. They're going to take out new debt. They're most likely going to do a second offering and stuff like that. But it still tells me that, hey, this company can survive without really doing that for the next 3 years. Right now, I want to take a look at some of their ownership. Since they have been a part of a bigger company, it doesn't seem individual insiders own much of it. This is something I'm not happy with, especially for it being such a low market cap. The general public owns about 80% of it. So Young Investor says they are expected to be profitable this year. They took a big hit, obviously, with Corona. They have built an MBA academy, 7 Starbucks locations, a Taco Bell, and loads of military contracts. So Young Investors, share some of those links of where you're seeing some of that. Is it in their investors presentation? So this is ticker Sgbx. Don't feel free to share links, Young Investor. So we can see the company is a bit overextended right now, but the moving averages is definitely in an uptrend. That's great news. Most of its volume is obviously in these lower prices. I'm pretty sure that's where the company was sitting at most of the time. Right now it's just trickling up. So overextended a bit, not something that scares me off, but something I like to see. Let's take a look at their investors relations website. Again, I think this is pretty cool, right? Containers are strong, fast, they're green, strong to build. Revenue based, right? 2020, they expect about $5 million. 2021, they expect about $20 million of revenue growth. So yeah, insane revenue growth here. Balance sheet, they have zero debt. They have huge cash and cash equivalents. To me, this is probably the strongest thing, young investor. Look at this estimation growth. They're in 2021, they're expected to have $20 million of revenue with a market cap of $50 million. Agreement with Blink for delivery of EV charging stations. This is also a pretty important. I guess this is where they're getting most of their backlog from. So they are in diversified revenue. This is a pretty cool company as well. I actually want to add both of these to them. So I hope you guys enjoyed that episode. Make sure to follow me on all my other social platforms, Twitch, Twitter. I am live streaming on Twitch every Mondays and Tuesdays at 8:30 Eastern time. And one day around the weekend, usually it's been Sundays right now around 10 o'clock in the morning for those that can't make it at night. So follow me on Twitch. The link should be down below. Also, make sure to follow me on my Discord channel. It's free to anybody that wants to join. And I post every time I buy and sell there. So take care, guys. Have a good night and see you next time.